Right, takes me then briefly to prospects, and some of you with good memories may look at this and say it hasn't changed too dramatically from what you had at the half year, and you'll be right. I think the dynamics haven't changed, massively from the half year. I think some of the key features are that perhaps economic growth, which was forecast at 2.5% to 3% or 2.8%, keeps being revised downwards. We're now at sub 2, and we hope that we actually finish the year at above 1. So that is definitely not very good for the country as a whole, and certainly for demand for office space, retail space, industrial space across our portfolio. A lot more competition, a lot of new listings, a lot of new stock coming onto the market. So it is increasingly competitive. The fundamentals, as I said, are not great in the domestic market here. Waterfront is different, and obviously Australia, again, giving us some diversification away from just the South African dynamics. Long-term interest rates look to continue to rise. I was pretty busy with TV and radio interviews yesterday, so I didn't catch all the news, but it seems like Europe is not looking that clever. So maybe the rise in interest rates or the pace at which the interest rates are set to rise might slow down a little bit. But certainly we've already seen the first short-term interest rate rises here in South Africa, with the view that there might be more to come, which all of that resulting in higher cost of debt and equity funding for ourselves. Opportunities, I think, given the massive investment activity that we undertook this year, it's probably fair to say that over the next 12, 24 months, there needs to be a little bit of consolidation, a little bit of introspection, trying to eke out the efficiencies of adding those property portfolios onto our existing platform. We still believe that being in the P and A grade office space with a heavy weighting to that is the place to be, instead of being exposed to the B and C grade properties. There remains a number of exciting development opportunities. We need to implement and enhance the acquisitions and focus on extracting efficiencies. I think, as I mentioned, weakening rand to Aussie. I think there's still certainly my personal view that notwithstanding the interest rate cycles that the different countries are in, that the rand stands to remain weaker to major currencies. The exposure to tourism through the hotel industry at the V&A, I think, is definitely an opportunity. And I think I've spoken about the V&A. It's almost a little microcosm on its own. Which brings me down to the outlook for distributions. I think we certainly see the macro environment and the low growth economic environment as being challenging. The rising interest rate cycle is not really helping matters. And the impact of that on the consumers and consumer spending is definitely having an impact on retail. We recently obviously saw the demise of Ellerins and Able. There's probably some spillover of that to still happen in the market, and the impact of that perhaps on the sectors that feed into that, maybe some manufacturing that feeds into that industry. We as Growthpoint did put out a SENS announcement highlighting our exposure to Ellerins at about 50 million rand a year, 0.7% of our gross annual income. So at that level, it's not a material number, but obviously that is almost gross for net. So it might be 50 million at the gross income level, but it's also 50 million at the distributable income level, which is more pronounced at about a 2.2% number. Now, that is a worst case scenario. So 50 million is if we got no rental from Ellerins for a full 12-month period. Excuse me. The reality is, in our financial year, we've already received rent for July. We've already received rent for August. There was a creditors meeting last week, Wednesday. There was something like 800 people who pitched at the creditors meeting. It was a bun fight. The business practitioner, or business rescue practitioner, decided to have a separate meeting of landlords, which took place on Tuesday this week. The feedback that I've got from that is that the business practitioner, they've obviously undertaken to come with a plan within 55 days, and they've offered in the meanwhile to pay 50% of their rental obligations as well as whatever utilities usage that they might be reusing, water, electricity, etc. So you can see that our 50 million exposure is already, reduced quite significantly. And it also is up to us to manage the exposures, to go and try and find tenants to re-let some of that space to. Stefan has done an exercise on his retail exposure. He believes he could halve his, let's say, loss of income, let's say, over a 12-month period of time. He can re-let some of that space. There are some other tenants in some of these shopping centres that want more space, so he can take some away from Ellerins and give it to these guys. There are 3 big exposures on the industrial side. We've got 3 major warehouses where we have Ellerins as a tenant. Engelbert's here. You can ask him. He's very confident that we've got takers for that space in the short term, actually. So we'll be approaching the business practitioner as soon as we're ready, with an opportunity to cancel those leases, get out of them, and re-let the space. So as a worst case, 50 million. Reality, I don't know where it will land, but it'll be significantly less than the 50 million. But given all of those dynamics, I think we took a view as a board that we'll guide for distribution growth next year of 7 to 7.5%, which is very much in line with what we have produced as an average over the last 5 years.